Despite Barack Obama's victory ending any uncertainty related to the presidential election, recession fears continue to scare investors off. Whether a Democratic White House and a Democratic Congress will be good for your money remains to be seen.
For some hardcore investment advice and where you should be stashing your cash right now, I'm joined by Ryan Mack, president of Optimum Capital Management, and Doug Flynn, a certified financial planner with Flynn Zito Capital Management.
Get your pens and pencils out for this one, because this is highly specific advice. Tell us what you just said in the commercial break.
I just said, in times like this, someone always makes a fortune. How, Doug, can I be someone who makes money in all of this nonsense, this chaos?
Well, you have to recognize what kind of a bull market we're in. And the bull market we're in is a bull market of volatility. And what I mean by that is if you go back the previous 30 years ending September, there were only 34 days in those 30 years where the market moved more than 4% in a day. Since that day, we've had about 16 days.
Right.
So we have increased volatility, and the likelihood is that that is going to continue. So what you need to do is you need to do things more than just long equity buying and holding. You have to do things that do well in those kinds of times.
I want to run you through a few things that you suggested to us. Number one, municipal bonds or municipal bond funds. Number two, market neutral strategies. Number three, global macro. And number four, hedged equity. These are very important. There's a very, let's start with municipal bonds funds. These are investments in bridges, roads, projects, cities, airports.
Yeah, you have to realize that relative to treasuries, the yield on munis is at unprecedented levels and the levels that we haven't seen in our lifetime. So way high relative to treasuries. You're getting more for going with a muni. However, there's more risk there, and that's why they're yielding more. There's going to be a lot of compression there. You're going to make some money on top of the yield. Some of these yields are in the 5–6% range, tax-free, over the next couple of years, and you may get some appreciation. So
tax-free on the state or federal level?
Yeah, both if you're buying one from your state, if your state has income taxes.
How do I find one of those? How do I find one of those?
Yeah, you always want to look at your favorite fund provider. If you're in a state that has a high state income tax, you'll look for one that is in your state. If not, you can use a federal one for a little more diversification.
Okay.
Market neutral strategies. You and I have spent many years talking about this. The idea that there are investments that you can make that operate, they are sort of agnostic to how the general market trend is going.
Exactly. We're just talking about a period of high volatility.
Right.
A market neutral strategy will go long, which means they'll buy stocks outright, and they'll go short. And the offsetting effect of that is that you sort of eliminate that volatility out of the portfolio. And so you can make money in a sideways up or down market. And you can look on Morningstar for all the long short funds. That's the category, is long short funds, and learn a little bit more about them. But that's when you're in a high volatility time, you don't want to just buy S&P 500 index fund and hold on. You might not make any money. You haven't since 2000.
Yeah, I just don't want to lose any more money.
What do we mean with global macro and hedged equity?
Global macro is really sort of futures, and they can go short and long in bonds, not just stocks. And hedged equity are when you start purchasing put options and selling covered calls. There are mutual funds that do all of these. You don't have to do it yourself, but those are the places you want to look in a high volatility sideways market, which is likely what we're in for this time. You know,
people pay an awful lot of money for this advice. I just hope everyone understands that they're getting some really fantastic free advice here today. I mean, this is what people are going and asking our guests these sorts of questions, and they're helping them, navigate what's happening here. Ryan Mack is here. Ryan, your favorite funds. Get a little bit. How can we make money, or at least stop losing money in this market? We should be deploying assets, right?
Well, definitely. Well, I'll pick three funds in here. Now, American Century Equity Income Fund, and Phil Davison is a portfolio manager of that fund. And three reasons why I like these funds are quality stocks. They do a great job of paying dividend yield stocks, which are usually more established companies, and these are the type of companies in the value play market. And right now, you're trying to seek out the value. Those stocks that have been downtrodden, but you want to make sure that you have those stocks that have high dividend yields, and that's one reason that American Century Equity Income Fund is very good.
We're going to keep that screen up there so that people can write down the tickers.
Yeah. Diversification, they have a very diversified portfolio. They play according to the Russell 3000 Value Index, but they don't only play to that. They give their portfolio managers a lot of discretion and a good management style and experience. The second fund here is Columbia Dividend Income. I really love this fund because it has, again, quality stocks. They have great management, and more importantly than anything, a steady, unwavering investment management style. I mean, at the end of the day, they've selected, because they have good free cash flow stocks. They have stocks that, they got rid of a lot of financials because they had poor free cash flow before they actually collapsed because of their investment style. Now, on the flip side of that, they didn't have a lot of energy stocks, don't have a lot of material stocks, so they didn't get on the high side of appreciation, but they do have a steady, unwavering style, very conservative style, and for the long run, it's great. And finally, a Vanguard Total Bond Market Index Fund. I think it's very great returns. a very broad benchmark. They follow the Lehman Brothers Aggregate Bond Index Fund. And very low expenses. I think that we have to look for these mutual funds out here that have low expenses. You know, 1.52% is way too high in this type market. This fund has a 0.19% expense ratio. So we have to make sure we have these mutual funds that don't have these high expenses, that erode long-term return. They have great quality stocks, good management style, at least 5 years or greater. You know, we don't want any funds that have, you know, these new managers. You don't have a good track record of history. So these funds and more, I think that are
and
good.
You both mentioned Morningstar is one of those places that, that every investor can go to, and they've got all sorts of criteria by which you can rate mutual funds, and they give them their own ratings, but you can really customize the whole thing. That's a wise thing for people who are wondering what to do right now to learn how to use.
Yeah, definitely. Well, I think 4- and 5-star rating on Morningstar, always go for that. Make sure that the mutual fund manager's been there for at least 5 years, a 1% or 1.5% expense ratio or lower, and make sure that there are no load mutual funds. Again, we don't want to be paying a whole lot of commissions. Every penny counts in this market, so no load mutual funds as opposed to loaded mutual funds are very crucial. And also look at the most important thing. What's their track record? The 3 and 5, the 10-year return on the S&P 500 or the Mack, according to that, have they beaten or at least equal to the return of the market for the 3 and 5 and 10-year rate of return?
I just like to find 2-star funds that become the next 5-star funds. I find a lot of times if you buy only 5-star funds, they turn into 2s. So try to do a little bit more digging than just look at the rating. That's one piece in the whole thing. Stay with the 4s that have good management.
All right, we could break every single one of these single tips you both given into segments of their own, and we might have to do that over the course of the next few weeks. So thank you for great advice, Ryan Mack and Doug Flynn.
All right, the economy, housing, energy, jobs. The CNN Money team breaks down the biggest challenges the president-elect will face when he takes office. It's a long list.